Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me for this segment, we have Kevin Davitt, head of index options content at Nasdaq, to discuss Nasdaq-100 volatility movement that we've seen over the past month. Kevin, it's great to see you as always. Welcome back to Trade Talks.
So good to see you, Jill. Thank you for having me back.
All right, you got it. It's been a minute here, so give us an update. What's going on in the world of index options?
Yeah, it has been, and that's an open-ended enough question that we could go in a lot of different directions. I'll choose to look at volumes to start, and if we evaluated volumes for Q3 of this year relative to Q3 of 2022, they were up 60%, so that's super exciting. Relative to 2 or 3 years ago, NDX volumes are multiples higher. Now, in fairness, the shift has been industry-wide. The macro environment, I think, has been conducive to index options growth since early 2021. And that's in part a function of added expiries. The short-dated option narrative has garnered a lot of attention, and much of it, at least in my opinion, is somewhat misguided. So to that point, I was at a conference this week with a handful of institutional options users and reps from a couple of big banks. And they pointed out how the outgrowth of expiries in the index world allows for far less path dependency with many index strategies. So when we had a single expiration monthly, the impact of an expiration week move could be very significant to the P&L of a strategy. That was muted with the introduction of weeklies, but with a much fuller term structure like we have now, you can layer exposure with a lot more granularity, and the impact of a single day's move matters less. And I think that rewards creativity in our industry. Beyond that, there are a number of new strategies coming to market where index optionality has been wrapped in an ETF, and they have garnered interest and they have garnered assets quickly. So it remains a really exciting time to be working in index options. And if you'll pardon the baseball analogy, I still feel like we're in the early innings.
All right, let's talk about Nasdaq-100 volatility over the past month or so. October certainly delivered based on its history.
It sure did. It's been an interesting ride over the past couple of months, whether you're talking about realized vol or implied vol. So let's keep in mind that looking back a month or so, we've been in kind of the teeth of earnings season. And typically, you'll see higher dispersion and lower volatility when companies are announcing quarterly earnings. From a realized volatility standpoint, the 10-day NDX historical vol has ranged between 15% and 25%, like you can see on the chart, since the start of October. That's shown as the white line. So on a short-term basis, moves have been more significant lately. Through the lens of implied volatility, the 1 month at the money vols have vacillated between about 18.5% to nearly 24%. But since the Fed meeting, or since about a week ago, 1 month vols have fallen to below 17%. That's depicted by the red line. You can see the collapse in 1 month vols over the past week. Now, to be clear, the Nasdaq-100 has rallied about 6.5% over that time frame. So a decline in vol is typical, but this one is quite pronounced. If we zoomed out a little bit further, the prevailing head or tailwinds have been tethered to yields. And I've talked on here before about the MOVE index, which I continue to follow. It evaluates forward vol expectations for the 10-year treasuries. That measured as high as 140 a month ago. That's unusually high. Now, the measure is down to about 119 last I looked. That's also historically high, but obviously down quite a bit. 10-year yields, I'm sure you've covered it on here, traded slightly through that 5% level just 2 weeks ago. And then following what many have termed a dovish pause from the Fed, they moved back down to nearly 4.5%. So there's been significant realized vol in rates. If we think about the rest of the year, I think that big picture narrative remains the same. So like, to what extent does the economy continue to chug along with higher borrowing costs? Will the yield curve disinvert? And will that be the real precursor to a recession? And if that occurs, Might we see a meaningful leg lower for equities with much higher volatility than we've experienced for most of this year? Or will it be just volatility swells without anything kind of breaking, so to speak?
So speaking of this year, Kevin, what's on your radar as you look out to the end of 2023?
So I suppose I just alluded to what I believe will continue to be the primary drivers in the form of the yield curve and sort of sensitivity to economic data. From a calendar perspective, November and December tend to be constructive for equities. I would like to point out that the double-digit drawdown from highs during a calendar year, like we've seen over the past couple of months, is totally normal. So I'm going to remain headline focused. I think employment will remain key, which is kind of always the case. And today's data was somewhat disappointing, but it's also supportive of lower rates. Consumer spending is also super important. And theoretically, if that can remain strong, if we have like this sub 4% unemployment, there are certainly areas of the economy that have been harder hit from a jobs perspective, but in aggregate, the labor market remains fairly strong. So that's my take on the last 8 weeks of the year. And I thank you for having me back on to talk about it.
All right, Kevin, appreciate your insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.